with all your knowledge and all your research and everything you've looked at from all the bubbles of the past, and we'll go into some of them. Are we in a bubble now with AI? Are the signs there?
You get a bubble whenever the price of something goes up by a lot and then it goes down by a lot, and when there's not an obvious reason why this happened.
Regulators and governments have short memories, and time passes and then they start to unwind a little bit of that stuff and some of those protections that have been put in place.
A heavy implication that there's a psychological element, that people start using this asset as an object of speculation. They buy it because they think, oh, the price of that is going up, and then the price of that goes up more and more people get involved because they see the price going up.
There will always be very smart people working in banking and finance and the investment world whose primary aim is to make some money. And they will not necessarily be acting in the same sort of moral or protective way that a bank or a regulator would. And I think it's true with any of these situations. People do talk about it. People do point at stuff and go, that's not right. That's a bit mad. But people ignore them and people dismiss them.
Confucius says, study the past if you would divine the future. But actually, is it useful here to think about what might be coming down the line by looking at the past? What do old bubbles tell us about what could potentially be new bubbles? Every generation thinks it knows more than the last, and yet we keep making the same mistakes. In the late 90s, we were repeatedly told that boom and bust was a thing of the past, and, well, we all know how that turned out. The details change: railways, property, crypto, AI, but the pattern doesn't. Bubbles keep happening, and they're happening more often. Some say we're due a crash soon. So how can you spot one, prepare for it, and what can booms and busts of the past teach us about money, markets, and our own behaviour? I'm Georgie Frost.
And I'm Simon Lambert.
And this is Investing Unlocked, making money make sense. We're joined today by the man who co-wrote the book on the subject, Will Quinn, financial historian and author of Boom and Bust, A Global History of Financial Bubbles. Now, Simon, I was a completely oblivious rookie sports reporter when the 2008 financial crisis was unfolding, so I have nothing of value to add to this particular conversation. But you were a financial journalist in the lead up and during who was reporting on this stuff. So the question I have to ask echoes that of Her Majesty when she spoke to a bunch of economists at the London School of Economics. Why did nobody notice it?
Was it why did nobody notice it, or why did nobody see it coming?
See, that's the way it's been turned. But actually, I did Google this, Simon, because I didn't throw this show together. And I think the exact phrasing, although our guests may know, was, why did nobody notice it?
Well, I think it's not true to say that nobody noticed it. And people were talking about it before it actually happened. Before the financial crisis was the credit crunch.
We're talking about the 2008, obviously.
Right. And the credit crunch was 2007. And I remember in 2007, before what was termed the credit crunch, and it's very difficult to put an exact date on this because it wasn't it happened on this day thing.
Yeah.
I remember there being talk about it before then, and there being stuff written about it, but people were dismissing that. And that's, I think, the point here is that people did raise it. And I think it's true with any of these situations. People do talk about it. People do point at stuff and go, that's not right. That's a bit mad. But people ignore them and people dismiss them.
Well, let's not talk about people, Simon. Let's talk about you. You were there. You were a financial journalist when this was all happening. What was it like?
What was it like?
In the build-up and at the moment, because I remember you saying to me since that you were going into the office and thinking, is another one going to go? Another bank going to go?
That was pretty mad. That was in the quite early days of my financial journalism career. And there were days when we were in the office and there were discussions around, is Barclays going to go under today? Is Lloyd's going to go under today? Is Halifax going to go under today? We also had to be quite careful about what we were writing. We had some of the banks, including some of the Icelandic banks, coming really quite heavy-handed because we were writing about red flags in the system, things like the complicated instruments like CDSs that were being traded that were flashing these big red warning signs. And we had the decision one day to make of, on a Friday night, someone said to us, IceSave, which is one of the Icelandic banks, is going to go under. Look at this, it's going to go under. And we had this, what do we do? Do you write a story that says IceSave is going to go under this weekend? Take your money out. Ultimately, you couldn't do that because it'd be irresponsible. You trigger a bank run.
Mm-hmm.
But lo and behold, IceSave did go under. People got their money stuck in IceSave. So it was a really weird time. But what I would say is the easiest thing to compare it to is 6 years ago, almost, the pandemic. You very quickly get used to things. Humans are strange creatures. You never imagined in your life that you would be told you weren't allowed to leave the house and you'd be in lockdown. And then all of a sudden, within 2 weeks, you were totally used to it. Same for the financial crisis. You never imagined in your life that you'd be talking about some of the biggest banks in the country going bust. And then all of a sudden, it was happening and it just sort of became normal for a while.
It's almost like something like that had never happened before. But actually, we know that booms and busts have happened before. We have the man who's co-written the book. Will, thank you so much for coming in and talking to us about this. Before we go any further, what's a bubble? Just explain to us, when we're talking about boom and busts and bubbles, what exactly is it?
The short answer is that you get a bubble whenever the price of something goes up by a lot and then it goes down by a lot. And when there's not an obvious reason why this happened. So sometimes you think of oil prices recently. So Russia gets involved in Ukraine and the price of oil goes up. And then a few years later it comes back down again. We wouldn't call that a bubble because there's a good reason. The characteristics of a bubble is that there doesn't seem to be a very good reason. And there's a heavy implication that there's a psychological element, that people start using this asset as an object of speculation. They buy it because they think, oh, the price of that is going up. And then the price of that goes up more and more people get involved because they see the price going up. And eventually this gets to the point where the price of this asset has nothing to do with how much it's actually worth. And at a certain point, the whole thing runs out of fuel and we get a crash and the price comes back down again.
Would you say that in order for it to be a bubble, the price has to come back down again? Or is it just the case that you would very rarely get a bubble where the price just didn't come back down again?
So one example that some would argue is an example of a bubble that never burst is gold, where we've decided as a society that gold is worth something, and the price of it historically has just continued to rise with lots of fluctuations, but it continues to rise. But there's nothing about gold that necessarily makes it that valuable. You could argue it's a collective delusion, but it's an example of how these collective delusions can last for a very, very long time, thousands of years.
So are we in a bubble now with AI? With all your knowledge and all your research and everything you've looked at from all the bubbles of the past, and we'll go into some of them, are the signs there?
So I'd say some of the signs are. There's sort of a sniff test you can do of, what is the price of these assets? What is the price of these stocks? And how much money are these companies making? Or how much money could I reasonably expect these companies to make? And whether those things are out of whack, whether they seem out of whack. And if they're out of whack, you think, okay, maybe this is a bubble. Maybe there's something going on here. Now, sometimes there's a very good reason for that this is a very innovative company that's expected rightly to make lots of money in the future. But it's a good place to start. And then you start to look for other warning signs. So in the book, we talk about marketability, which is a bit like liquidity. So,
you talk about the triangle, don't you?
Right.
A bit like fire. What you need to have a fire. You talk about a triangle, what you need to have to bubble.
Exactly.
Explain that.
So in the fire triangle, you have three sides. You have oxygen.
I'm thinking back towards his chemistry.
Right.
Yeah, oxygen, heat, and a spark.
And fuel.
Yeah.
And then you need a spark.
And then you need a spark, yeah.
Exactly, yeah.
As a great man said, you can't start a fire without a spark.
Okay, so we've got our triangle, but what's the equivalent for then a bubble?
So for oxygen is what we call marketability. So how easy is it to buy and sell this asset? The dynamics I explained where the price goes up, so more people get involved because the price is going up. It's no fun if you can't easily buy and sell an asset. So if you go back in time to for example, a communist country, China before 1990, they didn't really have financial bubbles because you don't have that ease of buying and selling assets. So this is something that's necessary. And we quite often see financial bubbles occur after something becomes much more liquid, much easier to buy and sell. And the most obvious example of this is mortgage-backed securities.
Yeah.
So you had this asset, a mortgage, which sat on a bank's balance sheet that they couldn't do anything with. And suddenly, through this financial magic, it becomes something that you can buy and sell and speculate on in all kinds of ways.
Absolutely. So can you tell when a bubble is about to burst? I'm still going on about this AI thing, but like, let's say we are in a bubble here. Is there any way that you can tell it's going to burst? Because actually, what you say is we're getting them more often, aren't they? That's not just
Mhm.
me thinking we are actually getting them. What is it on average about every 6 years or something now?
Quite often, yeah. It's hard to say exactly because,
And we're talking about around the globe, not like,
right,
yeah.
because what constitutes a bubble isn't entirely clear, but they are definitely more common. So if we look at between the 1929 crash and the 1980s, aren't really any major bubbles anywhere in the world. And then from the 1980s, we have Japan,
Mm-hmm.
we have Scandinavian housing bubbles. We have the Asian stock market boom, which crashes in 1997. Then we have the dot-com bubble. Then we have the big one, the housing bubbles all around the world. Then we have Chinese stock market bubbles in 2007 and 2015. Now we have crypto, meme stocks, and potentially AI. It's a lot more common than they used to be.
I want to say a quote because I think it's quite illustrative of the psychology around bubbles. It was from Sir Isaac Newton, who is not an unintelligent man, I think is fair to say. He's famously quoted as saying, "I can calculate the motions of heavenly bodies, but not the madness of people." And doesn't that just sum up, I think, the craziness around some of the bubbles that we've seen?
Sometimes, yeah, I think there's definitely a psychological element here where people get very much overexcited about something, or they do it because all of their friends are doing it. But there's
What's the
all
greatest example you've seen of that?
um,
Crypto?
crypto is an interesting one. It's almost a case study in bubbles because it's something that I've lived through, where you
Yeah.
can see how it spreads from people to people, the kind of the stories associated with it, the communities and the identities that build up around it. People have made crypto like a core part of their identity, which if you own stock in Barclays, that's not really a part of who you are and how
Mhm.
you think of yourself. So that
I mean, it might be, but, generally not.
would
Yeah.
be unusual
Yeah.
if that was the case. Whereas with crypto, it's quite common. And these almost sort of non-financial, emotional reasons to invest are something that seem to come up with financial bubbles again and again.
But going back to that quote, is it actually true though? Because actually, when you look at a lot of these bubbles, and there is the classic bubble chart, there's the line that goes like that, and then it goes suddenly up in the air, and
Mhm.
then there's the slight dip, and then there's the hits the top, and then there's the comes down in a crash. Actually, you can overlay those charts on top of each other, and they do all follow a very similar pattern. Is that true?
Yeah.
Or is that just people making charts fit what they want to show?
To an extent, I think it's a pattern that we've observed and that we can see again and again. But I would also say that people are always saying we're in a bubble, whether we are or not. And maybe when we talk about the madness of people that lose money in a bubble, we don't really talk about the madness of people who say we're in a bubble whenever actually it's the greatest time in history to
Mm.
invest in stocks. So historically, it's say 2008, right at the end of the financial crisis. We look back then, it's like, oh, if you were buying stocks then, this was like a fantastic investment opportunity. But a lot of people were like, no, I don't think so. I'm not interested in that. And we don't really think of that as sort of irrational or crazy. So there's a bit of an imbalance here.
So what should you be thinking then if it's possible that, let's say, we are in a bubble, and what psychologically, I suppose, should you be thinking? Because like we said, it's the madness of people, but nobody's looking around and going, well, this is mad, because we're still going, aren't we?
Yeah, to an extent, I think, as Simon rightly said about the 2000s, people are to talk about bubbles during bubbles. There is always a cohort of people who are saying, I think this is a bubble. Sometimes they're saying it's a bubble too early.
Mm-hmm,
So
mm-hmm.
people were saying, the US stock market was in a bubble in 1996. And if you look back, that was a good time to have invested. And the dot-com bubble only burst in 2000. So by the time it got to 2000, people were like, I'm not really
That's the thing,
in.
you could say it at any time, and you're probably inevitably going to be right at some stage,
Right, exactly.
eventually. But you might have lost out in that time that you haven't been investing, right?
And you're not necessarily giving good financial advice if you're telling people to never invest, because lots of people who should invest don't invest. So
What's the craziest, because there are some crazy stories in this book, but what's the craziest bubble type story that you've come across?
So One from the book is the story of Gregor MacGregor.
Oh, my favourite. I've even written it down, the quote here from the book. It's so good. Tell
Right.
us.
So Gregor MacGregor was a Scottish entrepreneur who decided he was going to market the government bonds of the country of Poyais. And the problem with the country of Poyais was that it didn't exist.
Yes,
This
always
was
a problem.
Essentially a region of Latin America that he said, well, there could be a country there one day, but for now it doesn't exist.
I mean, there was some land.
Right, there
Not
was some
great land to live in or anything like that, but
not,
there was
not
some
livable land, but land. And he decided that land was Poyais, and I'm going to become involved with its fictional government, and I'm going to sell bonds to people. And he convinced lots of people to invest. He even convinced lots of people to move there, most of whom, unfortunately, died a painful death.
Yeah, didn't survive. But it came at a time when people were investing in Latin American bonds. It was, didn't come out of nowhere. It didn't just go, I'm going to make up this country and invest in this, right?
Yeah, this was part of a boom in Latin American stocks and Latin American government bonds, Latin American companies. And one of the interesting features of this is that we do see signs that it was associated with a particular identity. So if you're living in London at that time and you're investing in Latin American companies, you're thinking of yourself as very worldly.
A bit shishy, a bit.
Right, exactly.
Yeah, you know what you're talking about. Okay.
I mean, this sounds very similar to someone deciding to set up a new crypto coin.
The interesting thing about that is that these, what would have previously taken maybe 10 years, or sort of played out over a number of months, but with crypto coins, they seem to take place in about a week. You have, the Hawk Tuah coin, and it booms for about 5 days, and then it crashes, and the whole thing blows up, and there's a whole controversy about it. And then the next week, there's a new coin that's doing exactly the same thing. They've really condensed this cycle into a matter of hours, even.
The thing about crypto is underlying people's exuberance, shall we call it, there is, for some people, a belief that this might be a new way of a financial system. Whether that's true or not, is yet to be seen. But not all bubbles and booms and busts are bad, are they? I think this attitude that, and we had it with Gordon Brown, which I mentioned at the start, that the boom and bust era is over. Well, that was spectacularly wrong. But with an idea that the busts are always bad, these booms and busts are always bad, when can they possibly be good?
So whenever you say that a particular sector is in a bubble, what you're really saying is like, all those companies are overvalued. So right now you would be saying like, AI companies are overvalued. And that's bad if you're an investor. If you're thinking, I want to buy AI companies, you're getting ripped off essentially. But if you flip it around and look at it from a company's perspective, what you're saying is it's really, really cheap for them to raise money. And they could be very innovative companies. So during the dot-com boom, one of the features was that if you were starting an internet company at a time when these were having a major long-term impact on the world, suddenly it was really easy for you to make loads of money. People weren't asking you too many questions. They were just throwing money at you and saying, look, go change the world with that. And for investors, it can be pretty painful. You still don't want to be holding these stocks whenever the crash arrives. But it can end up with very innovative companies that produce this world-changing technology.
And does that ultimately mean that quite a few of these bubbles can end up being quite good for the population at large? Because whilst it's bad for the investors who lose money, it's good for the population at large who might get a new technology delivered to them in a way that they wouldn't otherwise do. For example, railways, the internet, possibly we're even going to benefit from all these data centers, although I have my doubts.
It's definitely possible. I mean, if the AI bubble were to burst, we would just have cheap compute for years, and that would benefit everyone, except the people who were heavily invested in AI. It's hard to completely quantify, of course. You can't say that there are costs as well as benefits. A lot of that money is wasted. You could say if we had more efficient markets, maybe the money wouldn't have been used so spuriously.
When you say efficient market, what do you mean?
So a situation where prices roughly reflect how much each company is worth. And the idea there is that how much money you're able to raise as a company depends on how good you are as a company, how much money you're able to make. So that's generally considered a fairly good thing for society. But there are exceptions, and one of the exceptions are super innovative firms where they could be producing this technology that benefits everyone in the long term.
So there are benefits, and that's the thing. There are different bubbles with different repercussions. And you talk about some that are, have good technology and that carry on, and some
Mhm.
that actually were just, bad for the investors, and some that actually were bad for the economy and people generally. Simon, I want to ask you, from the perspective of the 2008 financial crisis, what's been the long-term impact of that?
Well, the 2008 financial crisis, I would say, is probably an example of a bubble that was bad for the population at large.
Yeah, that's where I
right?
was getting at, basically.
Because ultimately what you had was the financial system. It was decided that the private companies that were playing within that space and had effectively created this large bubble, the big banks around the world, were deemed too big to fail. And instead of those banks just going bust, their shareholders taking the losses, their bondholders taking the losses, governments stepped in, and we all ended up on the hook for it. And the cost of government stepping in and us all ending up on the hook for it remained for years. Arguably, it remained probably nearly all the way up until, it possibly still remains now, but it certainly remained all the way up to, or almost all the way up to, COVID. Unfortunately, what happened is just when we pretty much paid the bill or got over it, COVID happened, and then we ended up on the hook for even more money. That's going to take a very long time to unwind. And one of the things people say about a debt-fueled boom is that you're borrowing from the future. You're borrowing from future growth. And ultimately, at some point, you have to pay that back. Now, the developed world has done a spectacularly good job, I would argue, of attempting to kick that can as far down the road as it can keep kicking it.
Yeah.
But ultimately, we are going to have to pay that back. And we have been paying it back, certainly in this country, through, arguably lower growth than we would have had since the financial crisis, although you then have to allow for other things that have happened as well.
Will, what did you see as the long-term consequences?
So I think this is, as you say, just like a prototypical example of a terrible bubble where there's no technology involved, there are no clear benefits, and everyone bears the consequences whenever it bursts. And what made it so destructive was the fact that banks were so heavily involved in it. So housing markets are built on mortgage lending. So whenever there's a housing downturn, suddenly lots of these people are in negative equity, the banks are facing losses. And whenever banks are facing losses, sometimes they fail, sometimes they just cut back on credit. And this is a problem for everyone because every single part of the economy uses banks. If another industry experiences problems, there'll be some knock-on effects. But the banks, whenever they experience trouble, it affects everyone. Anyone who's ever needed to open a bank account, or businesses that have needed to borrow money, or people that need to mortgage in order to buy a house, they're all suffering whenever the banks get into trouble. And the problem with this housing bubble was that the banks were so heavily exposed, it created so many issues that it affected everyone all around the world.
So there is an alternative reality where we just let it happen. And
let everything fail?
Yeah. And then you just went, okay,
what would have
creative destruction or whatever you want to call it.
In this alternative
you
universe?
would have seen people lose their savings. You would have seen people lose their houses. You would have seen the aftermath of that. Because bear in mind that in the immediate, after the credit crunch impact, what happened was mortgage rates rocketed, and people who were expecting to be able to remortgage at roughly the same rate that their mortgage was on were suddenly facing colossal jumps in payments if they could even get a mortgage. There were some people who couldn't even get a mortgage. So you would see a huge amount of pain imposed on people, and perhaps you would find some people who would argue that would have been the right thing to do because it would have just cleansed the system, and then we start again and then we move on. But also you can see examples of times in the past where some of that burden has fallen more heavily on people, and then it has taken a very long time for the situation to recover. And if you look back to the sort of the housing crash in this country at the tail end of the 80s and the early 90s, that fell a lot more on people there was a lot of more repossessions. Lots of people lost their homes. Lots of people lost their businesses. Lots of people lost their jobs. And most people came back from it, but there are some people who never came back from it. And the pain that lasted after that lasted a much longer period of time.
And I think it's important to note the very human cost of bubbles bursting. We talk about investors losing money, etc., but actually there are some very, very real consequences of it. Do you think that the financial crisis is the most damaging bubble that we've seen? And is there a chance that it could happen again? I know that the banks have changed, and could we see something that damaging happen again? And actually, is there a greater risk? Because one of the elements you spoke about was marketability. Government wants to get more of it. It's not just the UK, of course. This is a global thing. But, government wants us to invest more. People want to get investing, etc. Is there a danger that we're just throwing more fuel onto what could potentially be a very big fire should it come in the future?
Well, I think that the risk factor isn't how many people are investing in the stock market at any given time. The risk factor is how exposed are the banks. So the question isn't how many people will sort of be involved in this market. It's if there's a downturn, what's going to happen to the banks? And it's very possible that something
so actually, you may not be investing at all, and you can still be very badly affected should there be a bubble that's crash. Yeah.
Whenever banks fail, it's the tentacles just spread right through the world.
But have the banks learned from that? Is there enough evidence that suggests that we aren't going to go there again?
The question is maybe more, have governments learned from that? Have regulators learned from that? They've made a lot of changes in terms of that they are conducting these sensitivity reports and thinking about this in some depth of what can the financial system withstand. Say what you will about governments, but when they make one mistake, they usually make the opposite mistake next. So
Right.
I don't imagine that they're going to, allow a massive housing crash to take down the banks again next time. But it's more something that they don't see coming. It's something from the opposite angle. They may err too much on the side of safety. They may start regulating banks too hard to the point where they can't function as effectively as they possibly could. They're all possibilities, but definitely at some point in the future, we will have another financial crisis at some point, hopefully not in the near future, but history tells us that they always roll around again eventually.
Simon?
I mean, it would be nice to not have another financial crisis for a while.
Yes,
It would be nice
yes.
if we're going to have a bubble burst. It would be nice to have it for it to be a different bubble. For example, not a financial crisis again,
Spread
because
the love out
that
through
one wasn't that
industries.
long ago. I mean, the only thing I would add to what Will said there is that regulators and governments have short memories, and time passes, and then they start to unwind a little bit of that stuff and some of those protections that have been put in place. And I think they underestimate the private sector at their peril. There will always be very smart people working in banking and finance and the investment world whose primary aim is to make some money. And they will not necessarily be acting in the same sort of moral or protective way that a bank or a regulator would. So when you start talking about, unwinding limits on things like interest-only mortgages or borrowing caps, borrowing limits and things like that, then that's when you start to potentially see the seeds being sown. For example, you might have the president of one of the largest countries in the world who believes that the interest rate setting should not be as independent as it potentially is, and that interest rates should be lower, and starts trying to intervene to get what he wants.
Is in that the mythical land of Poyais?
Yeah,
You're talking about the president
and
there.
they may also, for good reason, in order to try to help consumers, they may say, look, this is absolutely outrageous that credit card companies are charging people 30% interest and it should be capped at 10%. And they might be doing that for altruistic reasons. They might think that this is unfair and banks are making too much money off people. But the upshot of that might be that all of a sudden, when credit card rates come down from 30% to 10%, a load of people go out and borrow a load of money on credit cards, and you get a big boom in credit card borrowing that ultimately leads to a bubble. So, that's happening within short memory of a financial crisis.
Before we carry on, a quick word from our sponsor, PensionBee. If you're listening to this podcast, chances are you care a bit about investing and making the most of your money. Here's the thing, though. You don't have to be a pensioner to care about your pension. In fact, the earlier you pay attention, the more powerful it can be. Your pension is likely to be one of, if not the biggest investment you have, yet it's often the one people ignore for the longest. That's where PensionBee comes in. They're a leading online pension provider focused on helping people build confidence and take real control of their retirement savings at any stage of their life. Their app and website make it easy to combine old pension pots, manage contributions flexibly, and see exactly what's happening with your money, all in one place. You can also access your pension from age 55, rising to 57 from 2028. If you want to take a more active role in your pension investing, download the PensionBee app or visit their website to get started. Remember, when investing, your capital is at risk. So Confucius says, it's always good to start a sentence. Confucius says, study the past if you would divine the future. We've talked a lot about the past. Obviously, you've written a book about it. It would be silly not to. But actually, is it useful here to think about what might be coming down the line by looking at the past? What do old bubbles tell us about what could potentially be new bubbles?
So I think that the patterns recur, so we know what to look for when we want to know whether we're in a bubble. Things like hype and narratives sort of around new technologies, government policies. We come back to the fire metaphor. We have two types of spark for bubbles in the book, and one of them is technology, which we've talked about a lot. But the other one is political. So it's very often government policy, which can be implementing regulation. It can also be deregulating. But whatever it is that they do, it causes the price of an asset to start to rise, and that's very often the cause of bubbles and the cause of the really destructive bubbles. So these are the patterns that we want to try to look for. We see bubbles are more common whenever interest rates are low. It's kind of a quite widely observed phenomenon where
because people are looking around for something else, right? As soon as you give them better returns.
Borrowed money and investing in a bubble asset with other people's money can be a lot more fun.
Just to jump in there, Simon talks about, you both talked about, governments, regulators, banks. There is a theme that comes up again, which you've looked at, which is the role of the financial media.
Mm-hmm.
So if you are an investor and you're trying to look at all the signs for whether we're in a bubble and what you should be doing, you are by and large going to be reading the financial media as well. Did you focus on the financial media because obviously it's a great wealth of source material, or was there something else that made you want to look at the role of the financial media?
Yes, so it's both. It's a great source for any historian.
Of course.
The news media is just great because it reports things to an extent it's trustworthy, but you also get to see what people were thinking at the time. In the case of a bubble, what information did people have access to at the time? Because we can look back and say, oh, this was crazy. How could these people have possibly believed that Poyais was a real country? But at the time, how were they to know? It could be that the news media were reporting this as if it was real and that they trusted that and they had good reason to trust that. You can't really judge them unless you're seeing things from their perspective with the information that they had. It's also interesting to see what the media is doing with respect to the bubble. So are they throwing fire on it? In the 2000s, a lot of the newspapers were running advertisements for property development and that there's a lot going on at the time that was potentially throwing fuel on the fire. But then you also have voices that are saying, hold on a minute, that there's something going on here. And it's this balance between, are they making things worse, or are they sort of a harbinger that people should have paid more attention to? And we often find that there's a mix.
And how does that compare now when you look at it? Because obviously a lot of these bubbles that you're talking about are, some time ago, but things have changed dramatically in the last decade, for example. So now it's not just the financial media, it's social media.
Yeah.
When you look at things now, do you see social media as playing a bigger part in that herd mentality than financial media,
Definitely,
the traditional press.
I think we've almost moved past what I would have described as social media. Whereas for me, social media was things spreading peer to peer, like around.
It was social.
Exactly.
Yeah.
So
Our
sort of,
mates.
so maybe all your friends are investing in crypto and they're tweeting about it or they're posting on Instagram about it, and then you get interested and it spreads that way. Whereas now social media seems to be you're watching videos of influencers. It's TikTok is a world that I'm just too old to understand, right? It's they're potentially you don't know what their interests are. They're going viral. You have these sort of small number of people with enormous audiences, and information is spreading that way, and that's how a lot of people are getting their financial advice. And in some ways that can be a good thing. Some of these people can be offering very reliable financial advice on some very good podcasts, for example. But there are also some people, especially if they're targeting younger audiences. I've seen viral instructions on how to do fraud, although they didn't say this was what it was. It's like, here's a fun financial life hack of spending a check with money that you don't have in your account. And this is the type of thing that you start to worry about, that it's a different information environment, and one that I think even I might be too old to understand.
What impact do you think that will have going forward then? Do you think that will be perhaps like Simon said, the biggest cause of where bubbles go next, I suppose?
Yeah, I think the information environment is changing. The main trend I can really pick up on at the moment is that these things happen much faster.
Exactly.
Whenever people are able to continually update their news feeds, minute by minute, we see meme coins with bubbles that last a matter of days, whereas previously a bubble was something that would play out maybe over a number of years.
And you think that's because of the speed of the information?
I think that's the speed of information and the amount of information that people have at their fingertips now. It's a very different world. And how the future might play out, I don't know. I don't think that's something I can predict.
Because you have to consider as well that put into that mix is not just people and information and people reading the information or watching the information, but algorithms.
Oh, yeah.
And the algorithms designed by the social media giants to get people to consume more of that at an increasingly high velocity, and also the trend at the moment to consume as much of it as possible in really short bursts.
Yep.
That's like pouring petrol on the fire, and then maybe pouring some other really flammable stuff on top of the petrol and then some stuff on top of that. And I think that with that, what people need to do is they need to take a step back themselves and ultimately accept some personal responsibility and go, well, bubbles would not occur without herd mentality, and herd mentality would not occur without people doing these things. And I am a person and I have control over what I do, and I need to employ some critical thinking here in terms of what I digest, what I do, how I act. But I think the problem that people face is that the internet is currently, the digital world is currently developing at a faster pace than they can possibly process it and develop their own critical thinking.
Yeah, and I mean, you could go down the route of, do we think that we are training kids now to have the skills in critical thinking, or just to absorb what, like you said, before it was social media, it was interactions. Now it seems just consume. And there is a concern that it's so difficult anyway. We know all the research suggests that, it's so difficult to move away from the crowd. You spoke about it earlier. Yes, people were asking those questions during the financial crisis. There were always people that ask questions, that think things are overvalued. And yet, herd mentality is a thing. The madness of crowds, we still do it because it's really hard to go, hang on a minute, something's not right here. If everybody else is saying it, and everybody now, whether it's on social media or in the financial press or in the general press, is an expert. And there's so much information out there, and it's hard to keep on top of things, to feel like you know enough to say, actually, no, I'm not going to believe what you say. How do you develop that kind of critical thinking, Simon?
Well, it's even harder if you're trying to stand out from the crowd and everybody else in the crowd appears to be making a load of money.
Yeah, exactly.
I mean, yeah, so I think arguably it comes down to the take a step back and try to look at the situation with a cool head and go, does this look entirely right? And does it look, does it look like this is built on sand? Does it, are there the red flags of the sort of herd mentality, this stuff doesn't stack up, the people are making like absolutely outsized returns, if they genuinely are making those outsized returns, because they could of course be lying to me about those.
Yeah.
And what is the justification for that? And if you are dubious about it, then either, don't play the game, or only play the game with money that you can afford to lose. Because it's not to say you can't play the game, but maybe, don't go all in.
Is there something, Simon, that you should be doing or could be doing in terms of, I suppose, restructuring of your portfolio if you think that we are in a bubble, just to protect yourself? Have a bit more in cash, perhaps, if the markets drop and you might need to access your money?
Well, I think if you detach it from things like actively choosing to speculate in a bubble, then, and you look at it from the perspective of, I have an investment portfolio, it's diversified, it's spread across lots of different things, I don't have all my eggs in one basket, then looking at that and going, am I concerned, for example, at the moment that the stock market is in a bubble because it's being led by the US stock market, which has gone up by an awful lot, which is being led by a relatively small number of companies, which are all sort of the same trade on technology and AI. And I've decided that I think there's the risk of a bubble there. Then you can look at it and go, how do I limit my exposure to that? One way is by perhaps investing some of your money into some other things that are less affected by that. For example, that are not directly tied into it. So, for example, if you are an ordinary investor, one way of doing that might be to hold a FTSE 100 or a FTSE All-Share Tracker fund. The UK stock market doesn't have a lot of technology in it, doesn't have a lot of AI in it. It's not a market driven by that. It's a market driven by other things. Now, that has meant that investors in the UK stock market have fallen behind the global market and the US market, driven by other things in recent years. But it might mean that in the future, if that house of cards comes tumbling down, those investors will be insulated to a degree. It's highly likely if the house of cards comes tumbling down, then certainly the stock market in this country is going to fall as well. It's likely that everything will fall, but it might be that you're more protected from it. Or it might be that you go, actually, I'm going to look at things other than the stock market. So the traditional portfolio is stocks and bonds. And the idea is that when stocks do well, bonds don't do so good. But when stocks do
Not always the
badly,
case, though, is it?
people rush to the safety of bonds. Sometimes you see them fall at the same time, because ultimately you might have the same cheap money trade going on. And this is something that happened recently in 2022. But there's an alternative that you have as an individual investor that isn't really open to most of the people in the institutional investment world, the big, the huge global investors, which is you can just hold some cash. Now, you're not going to see a scenario where you get that kind of approach, the scales thing, where the stock market goes down, the bonds go up because people rush to safety with cash. You're not going to see your value of your cash go up, but you will see that its value go up in terms of the fact that you've protected yourself from that stock market. And you might also be of the opinion that perhaps if the stock market falls 30%, then that's quite rare that that happens. And what usually happens is it turns out to be a pretty good time to buy. So you could have your number, and your number could be 20% or it could be 30%. You could be like, if the market falls by that much, I'm going to put some of my cash to work and I'm going to buy into it. You're taking a risk, but you are buying when the stock market is on sale. And ultimately, you're taking advantage of what you potentially perceived as a bubble, falling. If we go back to what Will was saying, though, with some bubbles, it might be so detached from the intrinsic value of that thing that there is no guarantee that it will go up again. Now, each time that Bitcoin has hit a peak and then taken a massive tumble, it's reached a point where people have bought back in. It is a fascinating case study of watching something go from nowhere to becoming an asset that people think has some value, even though it really has no value whatsoever.
Right, I was going to say, what is its intrinsic value?
Nothing.
Yeah.
It's like nothing. I think it's nothing. But, I don't, there is no use for it other than transacting. But you can only transact with someone in Bitcoin, and you could just use normal money instead. Gold does have some uses and is used as jewelry.
Mm-hmm.
Bitcoin isn't used as jewelry. It doesn't really have any uses. And so, it's not, you've asked me this question before when we've been talking, is it digital gold? And my answer to that is, ask me that question in 2,000 years and I'll give you an answer. Well, I can't tell you right now. Okay, but but what we have seen is a pattern emerge where each time it hits a peak, it comes down a load, and there comes a point where people go, right, that's enough, I'm buying back in. But you cannot guarantee that's going to happen. And it's different to buying into the stock market, for example, where what you are doing is you're investing your money into companies that are putting money to profitable use and actually, making profits from their business, or even the bond market, for example, where you are buying into the promise of someone paying you an interest rate return in the future. So you need to make a difference between things that are based purely on sentiment and things that are based because they actually have some productive use. And along with, for example, Bitcoin, I would say, there's gold that you talked about, but there's also things like classic cars, wine, art, purely sentiment-based value.
Absolutely right. But you've both spoken about, look, if the valuation doesn't feel quite right, but actually with some of the stocks we're seeing, particularly the growth stocks, particularly the tech stocks, it's quite hard, is it not, to work out what their true value is compared to perhaps some old legacy companies.
Yeah, that is definitely true. And this is often a feature of a bubble, is that you get a bubble in assets that are very hard to value. So as you say, Bitcoin, if you were to value it using traditional metrics, you would just say it's worth zero.
Yeah.
But people are paying something for it on the market. It's consistently been worth something. First for ideological reasons, which was the first reasons why people used it, was because they wanted a currency that was free of government control. They had these visions for a new financial system, and I think that some people still buy it for those reasons, and maybe this is what gives it a floor. But ultimately, it doesn't have any intrinsic use. .com bubble, those were stocks that weren't making any money at all yet. So people would look with the usual metrics and say, okay, what's the level of profit? Oh, you're not making any profit? Well, I'm not sure how to value this at all. But in the future, it's going to make some money, and that number could be anything. And this uncertainty is what creates this space for people to put a number on it that they think is reasonable, that they can just pull from anywhere, and often leads to this level of speculation. So yeah, I think this is kind of a recurring feature of bubbles, a recurring feature of bubble assets, is that they are very hard to value. But what I would say, maybe the way to sort of flip this around, is that the reason that I say, look at the price relative to how much money it's making, is because if a company is making a lot of money relative to its price, it might not necessarily still be a good investment, but you wouldn't call it a bubble. You wouldn't say that it's in a bubble.
Obviously, anybody who has been affected, and it's pretty much everyone, by the sting of the 2008 financial crisis would say, this is bad. We want to stop this happening. As to whether we could stop this happening, because you said it's generally down to sort of two reasons, policy and technology. Well, governments probably won't want to tie their hands by creating something that stops bubbles happening in the future. And it might be that the technology wouldn't have advanced as fast if we didn't have these booms and busts. So in that regard, is there anything that we could do to stop it? But would we want to?
Yeah, that's the big question. Would we want to? So we do have periods in history. In boom and bust, the first bubble that we write about is in 1720, and the next one is 1825. So you have 125 years there, over a century, whenever you don't really have any major financial bubbles. And the reason for that is the financial system is so repressed, you aren't allowed to form a joint stock company, so you can't have a bubble in the shares of companies. Banks and what banks can do are just very heavily controlled. And this occurred again during what we call the financial repression era, after World War II, where banks are very heavily controlled. We have capital controls, and what you can do with your money is tightly controlled. It's often very expensive to borrow money because banks aren't allowed to take any risk, and that means that if you want to borrow money from them, they're going to charge you very high interest rate. And for that, we get no financial bubbles or very small financial bubbles. We don't get financial crises. We don't have very many major bank failures. But on the other hand, the financial sector isn't working as well as it could. So I think the optimal number of bubbles isn't zero. Arguably, the optimal number of financial crises might not even be zero. Maybe it's just the price that we need to pay for a financial sector that does its job as effectively as it possibly can.
Goodness.
Of all the bubbles that you've written about, the stories in your book, which are the ones that you find the most interesting?
I like when there's, a particular individual that seems to really encapsulate the bubble, and then what that individual says about wider society. So the book I'm working on at the moment, there's a chapter about FTX and Sam Bankman-Fried. So that this person who a lot of people gave a lot of money to, who became good friends with regulators, was meeting frequently with regulators, was getting on a stage with Bill Clinton and Tony Blair.
What was FTX? A crypto exchange?
So FTX was a crypto exchange, and it was actually marketing itself as one of the more legitimate crypto exchanges. So it was breaking some laws, but it was marketing itself as more compliant, more legitimate, more safe. And it turned out that people who were depositing money at FTX in order to invest in crypto and buy and sell crypto, that money was essentially just being lifted out of their accounts, moved into another account, which was controlled by Sam Bankman-Fried.
And where is he now, Mr. Bankman-Fried?
He's in prison.
Oh, yes, so he is, yes. So it didn't work out too well there.
But what is interesting is not only these personalities and these really colorful episodes, but what it says about society. So it's like, why are so many people willing to overlook some red flags or listen to someone because they seem to be very rich? And I think part of the explanation is that in a bubble, a lot of people get rich out of pure luck. And whenever people see how rich they are, they think, here's someone I can trust with my money. Here's someone who's going to give me good advice. And quite often that turns out not to be the case.
I mean, that story is an astonishing story, the SBF story, which has so much more depth than I think people appreciate. And I mean, I read Michael Lewis's book about it, and it's the fact that the motivation, he wasn't even really that motivated by money.
No.
Then it was the things that you've almost forgotten, like the unbelievable amount he was paying celebrities to promote FTX, tens of millions of dollars. And then, I mean, the red flag for me, I remember before it collapsed, was when I saw Tony Blair and Bill Clinton on stage with him, I think in the Bahamas, and I was just like, oh, this is going to end badly. This is going to end badly. And lo and behold, it did.
So there you go. If anyone's in the Caribbean with a former president or anything, that's when you need to start to worry. Okay, Will, thank you so much for your time. I really appreciate that. Before we let you go, the £1,000 move, I'm going to give you £1,000. Alas, I'm not. But if I were to, where would you invest it? What would you do with it?
£1,000? Well, I'm a very boring investor when it comes to my own money. I would generally just...
sensible. Why don't you say sensible?
Yeah, I would generally spread it across lots of different index funds. Maybe a little underweight US stocks. I think Simon gave very good advice earlier on this. A little underweight US stocks, but generally just spread around various asset classes around the world. And my intention would be not to buy and sell very often, because I think the key to not losing money in the long term is not to buy and sell too frequently.
There we go. And finally, Simon says...
I think the thing that I've taken away from that conversation, the thing it made me think of, and I am a part of this, okay, I'm a financial journalist of 20 years experience, is never underestimate the power of the story. As humans, we love stories. We have learned through stories through the years. We convince each other through stories. So just be careful of the story. Whenever you're parting with your money or you're investing in something or something seems a bit too good to be true, or just ask yourself, does it seem too good to be true? Just remember how powerful those stories are in convincing you to do things. And then remember all those stories, the fables where it turns out that people did get mugged off.
Simon, Will, thank you so much. And thank you for joining us. If you want to get in touch with us, you can find us on social or you can email us. Remember to hit subscribe so you don't miss an episode, and make sure to tell your friends about us too. If you enjoy Investing Unlocked, especially our retirement episode, then I think you'll enjoy this from our sponsor Pension Bee, the Pension Confident podcast. Hosted by Philippa Lamb alongside a panel of financial experts, it's aimed at those who want to understand pensions and personal finance in a bit more depth without the jargon. They cover topics like ISAs, mortgages, the bank of mum and dad, as well as how to become a pension millionaire and the cost of divorce. There are new episodes every month, plus bonus content in between. You can listen on all major podcast platforms, in the Pension Bee app, or watch it on YouTube. Just remember, anything discussed isn't financial advice, and when investing, your capital is at risk. Search the Pension Confident podcast wherever you listen. Before you go, just a quick reminder that everything you've heard on this podcast is for information and education only. It's not personal financial advice, investing involves risk, and if you're unsure, it's best to speak to a regulated financial advisor.